Before we begin our next chapter and before we begin the fourth quarter of our course, I want to backtrack just a bit and go back over the reconciliation problem you had last week. When you open a checking account, it's very important that you understand the process of reconciliation. This process of reconciliation is to balance your checkbook with what the bank statement says. Each month, either electronically or by paper, you will receive a statement from your bank based on your checking account. They will tell you what the bank says you have, and you compare that with what your checkbook says you have. Just to back up before we get into this problem, just to back up a bit, remember that when you open a checking account, basically you're promising to pay. You must deposit money into your checking account with your bank, and when you write a check to a company or a person, you are promising to pay, so that when they take that check to their bank, then eventually they get the money that you owe to them. It's really simple. If you and your customer or your creditor has an account in the same bank that you have, in either Lima or Sandusky, for example, you write a check, they receive the check, they take it to the bank, and their bank is the same bank as your bank. Your bank then takes the money out of your account and gives it to them. That's pretty simple. But typically, more often, it will be that the person you pay the money to, the person you write the check to, has a bank in another city, another state, and it then becomes a bit more complicated. We're not going to get into all that complication right now, but basically it means that the check then goes from the creditor's bank to what's called a clearinghouse, eventually to your bank. Money is taken out of your account, and it eventually ends up into the bank of your creditor. So eventually the money that you owe to this person is paid out of your account to them. And it's very important, obviously, that you have money in your account in order for your bank to pay your creditor. So at the end of the month, or at least at some point in the month, the bank typically will send you a bank statement. Now, this typically will happen about the third week of each month. Again, you'll get it as a paper statement, or perhaps you'll get it electronically. But your task, and you should do this every month, your task is to make sure that your checking account and the bank statement agree. Now, on your screen, you see a problem that you had back on March 7th. And in this situation, the bank statement, which is right here, the bank statement has an ending balance of $830. When you look in your checkbook balance has an ending balance of $400. Now the temptation is to say, that's great, I have more money than I thought I had, and I'm just going to adjust my bank or my checkbook and say that I have $830. That is a mistake. What you need to do is to make sure that the two statements, the bank statement and your checkbook balance, agree. And right now they don't. So the problem you had back on the 7th of March was to reconcile that. And we'll start with that process. And I just want to make sure that you understand how this works. First of all, the dates are important. The bank statement in the problem I gave you is not dated. But typically, the bank statement would be, as I said earlier, be sent out around the third week of the month. So let's assume this bank statement is dated March 30th. Or excuse me, this bank statement is dated March 20th. I'm sorry. As I said, typically it's sent out about the third week of the month. Your checkbook balance that you look at is dated March 31st. So there's a little discrepancy there, and that's very important. Now, as we said in your problem, your checkbook balance shows $400, your bank statement shows $830, And the following information is very important. First of all, we will look at these outstanding checks. Outstanding checks are those that you wrote that are shown in your checkbook but are not shown on the bank statement. And the reason for that is that, again, the bank statement may be dated March 20th, and maybe these checks were written after March 20th. Or perhaps they were written earlier than that, but simply they have not been cashed yet. So you wrote a check for $90, check number 38 for $90. Maybe you wrote it March 5th, but it hasn't been cashed yet. Check number 311, same way, for $25, has not been cashed yet. Maybe you wrote it March 21st, March 25th. But at any rate, all of these checks, check number 320 is another one for $170. These have been written by you, they've been sent to the creditors by you, and they've been deducted from your checkbook balance, but they have not been shown on the bank statement. So these need to be put on your bank statement as a deduction. So up here you see subtracting outstanding checks. We would list those outstanding checks. So you would deduct 90, you would deduct 25, you would deduct 25, and you would deduct 170. So eventually those checks would be cashed, so the bank would deduct them from your balance. So that leaves you, if you know how to use Excel, you add those and subtract the outstanding checks, and that gives you a bank statement balance of $545. So we're not finished yet. There are outstanding deposits. So down here it says a deposit that you made but not shown on the bank statement. Again, if the bank statement is dated March 20th and you deposited this March 21st, this deposit of $50 would not be shown. So we need to add that $50, and that gives us an adjusted balance of $595. So that we're still not there. So now we've adjusted the bank statement. We've said the bank statement after these adjustments has an adjusted balance of $595. Your checkbook still says $400, so we're not there yet. But in the information that I've given you, there's a bank fee that's shown on the bank statement, but not in your checkbook, of $5. So we need to subtract $5. That's a bank fee. Oops, that's a minus $5. So that adjusts us to $395. There's also, on the bank statement, there's a indication that there's a, let's see up here, there's a deposit that's on your bank statement but not in your checkbook of $200. Obviously, you have your paycheck directly deposited. You've not put that in your checkbook yet, but you should. So we need to add to the checkbook balance at $200, and that would give you a final adjusted balance of $595. So we have adjusted the bank statement. We've included checks that you wrote that were not included on the bank statement. We've included a deposit that you made in the bank, but the bank did not have it on the bank statement. That adjusted the bank statement balance to $595. And to your $400 checkbook, we've deducted the bank fee of $5. We've added the outstanding deposit of $200 that you did not indicate in your checkbook, but the bank has, and that adds up to $595. So your adjusted checkbook balance is $595, and your adjusted bank balance is also $595. This is the process of reconciliation. Again, this is something that you should be doing every month to make sure that the bank and your checkbook agree. If there is a difficulty, if there's a problem that they don't agree, then you need to notify your bank as soon as possible, because the longer you let this lapse, the more problems you'll have. At this point, I'd like you to go back to your course page. There are some questions I want you to answer.